Hello everyone, welcome to episode 7, which is the final lesson in this 7-day series. If you've made it this far, congrats. I'm going to be diving into chart related things for the first half of the video, and then we'll be diving into some psychological exercises that you can practice to improve your trading in the second half of the video. The first thing I want to dive into is higher time frame analysis. We already talked about this. We already talked about how to find a draw on liquidity, but the next question may be, which time frames do you use? I know that is a common question because a lot of people are using weekly and daily charts. You don't always need to rely on these very high time frames to frame a bias. So on the weekly here, we have the S&P 500 chart. You can see that price is above buy side liquidity. If you've been following the analysis in the futures tab, you know that we've been bullish this entire way up. Okay, these have been targets up here. Once those targets are hit, I can't frame a weekly bias anymore. We're already at all-time highs. I don't know if it's going to expand higher, and if it does expand higher, I'll have no targets because price would be a new price discovery. If it expands back lower, I would need more confirmation just because price has been in a buy program. I wouldn't trust that first initial drop. So if I'm just looking at a weekly chart here and trying to find weekly bias, I can't do that. So what do? I go back down to the next lowest time frame. On a daily, price is above the weekly highs. It's created a change in the steady delivery bearish, but what we talked about in, I believe it was episode 3, is that when price is in a buy program on the higher time frame and it's consistently offering higher prices, like it's just returning to bullish PD arrays, it's expanding off of those and heading for buy side. It's in buy side delivery. Once we're above these highs, since price has been a buy program, I don't trust that initial 2022 model that shows up. So if I were to get more confirmation via price expanding back into the order block and then displacing much lower, then that would give me more confidence to start believing sell side would be targeted. But again, I'm not trusting the initial 2022 model in here because what can happen is price could just do one more run on stops and head for the highs above here. So I don't trust this initial daily model as we talked about in episode 3. Again, if it were to displace lower, maybe that can be some more confirmation. We'll play it by ear. So what am I going to do now if I don't have a daily bias? Well, I can just scale down to lower time frames. So I have the 16-hour, 12-hour, 9-hour, 8-hour, 6-hour. I'll scale between these different time frames. You can see that we still have that same kind of 2022 model. It just is a little bit bigger. When price pulls back lower, price is beneath sell side liquidity. So on this time frame, I could just mark out liquidity. You don't need to start off, or you don't need to always have a weekly or daily bias. If you cannot frame a daily bias, we'll drop down to a 4-hour. If you can't frame a 4-hour bias, drop down to an hour. If you can't frame an hour, you could drop down to a 15-minute, but you normally should be able to frame an hourly bias. So on the 4-hour, price took out liquidity here. We did have this previous low down here. Remember, NQ did take out that low, so it created SMT divergence. This is when ES makes a higher high. NQ made the, not a higher high, higher low. NQ made the lower low. Cracking correlation. Price starts to expand back higher. Go into an hourly time frame. Price created a change in the steady delivery higher with a fair value gap right there. So I'm using the hourly now for my bias time frame. So you don't always need such a high time frame. You just need to know where price is going, and you decide which time frame is clear to you. So if you look at the daily here, it may not be clear for higher prices because price just returned back to sell side liquidity. So you hop back down to a lower time frame. If I'm utilizing an hourly for bias, I'll typically look at a 5-minute to 1 minute for entries. I don't really do the pairing time frames. Like if I look at a 4-hour, I don't have an exact subordinate time frame to that. I'm always looking for setups between the 1 minute to 5-minute time frame, and it's best to look at 5-minute liquidity pools and higher if you want to look for high probability trades. Don't look at 1 minute liquidity pools because a lot of the time, especially if you are newer, it's not a significant level of liquidity and price will just displace right past that. So there are instances where I don't need it to run liquidity. Again, like since it ran liquidity right here, created a change in steady delivery, and then did a run on liquidity. If I'm anticipating the draw on liquidity to be higher here, and I'm looking for it to take out these highs, which is reasonable to expect since we have the cluster of highs above. So we have, this is what ICT would label a potential low resistance liquidity run when we have all of these highs clustered close together and price starts to expand higher. It should just start running through these with speed and velocity because it's going to want to take out all the engineered liquidity. So when I'm anticipating for higher prices and price returns back to sell side liquidity, this is where I can anticipate turtle soups to form. When price will run sell side liquidity, you're anticipating for smart money to buy that since price is already going to head higher. And you could use SMT divergence as confirmation for those turtle soups. So again, I'm always typically using a 1 to 5 minute for entries, and I could use a 1 hour for my higher time frame bias. If it's clear on the 4 hour, I'll use the 4 hour. If you're just looking at a daily time frame for bias and you're looking at a 1 minute time frame for entries, it's not always going to be that clear, because on the daily, for example, I'm not saying this is what it is, but let's say the bias was bearish, okay? And price, you're anticipating for price to trade down here. Again, I'm not saying that's what's going to happen. We're just using a theoretical example here. If the bias is bearish and you're anticipating for price to head down to here, well, there could be 4 days in here where it just retraces back up. So I'm not only looking for 1 minute entries short because the daily bias is bearish. I'm looking to align myself with order flow, typically on the hourly to 4 hour time frame. That's like a good little middle ground to find where you can frame intraday setups using that time frame. So as soon as price returns back to the change in state delivery, expands away from it, we have all of these highs over here. I'm adjusting my bias to order flow. So I'm just trying to get on side with smart money. So in here, price was expanding higher. We had this high. That was a likely bias. You can see it was engineering the liquidity in here. It went above this high temporarily. You could see that it was failing to reverse here. It just kept on setting higher highs. This was indicating it wanted to continue higher. So that's kind of what I do for higher time frame analysis. If I can't frame a weekly, I'll go down to a daily. Can't frame a daily, go down to a 4 hour. If I can't frame a 4 hour, go down to a 1 hour time frame. Your number one goal using this model, and where 90% of you will go wrong, is just hunting for the signature and price action. Don't just hunt for the change in the state delivery. If you're just hunting for the change in the state delivery, you'll be wrong half the time at least. The goal here, and I say that in confidence because this is what I was doing for the first, I don't know, three-ish months using the model. I was just looking for changes in the state delivery, and my success rate with it wasn't super high. So what I found to be a good add to that is finding where price is already going, then hunt the change in the state delivery in that direction, and that provides much more high probability setups. So now let's move on to the next point. Once we already know where price is going, this is when I refer back to midnight and 8:30 open. Again, I don't use this a ton, but it's something that when I do remember to put it on the chart, or when I'm anticipating for price to be in an expansion market, I will refer back to these levels. So we talked about the draw on liquidity being higher here. When the draw on liquidity is higher, you can mark out 8:30. Use this little horizontal ray on the left side of your chart. So if you click on the left-hand toolbar, click the right arrow, you could just click, where is it at? Horizontal ray. And what I'm looking to do is it doesn't matter what time frame you're on, just look for 8:30 and see when that opens. So I'm on a 15-minute time frame, see the open of this 8:30 candle, mark that out. And if you click on it with the horizontal ray, it'll just extend that out forever. Like it just keeps going out. I'm also going to do the same with midnight. So remember, everything that I've taught here, time-based model, using this midnight and 8:30, it's all based on New York time. ICT in the 2022 mentorship, he says that the algo is based off of New York time. So wherever you are in the world, if you're using these concepts, and specifically if you're trying to apply the time element, you want to make sure that your chart is on New York time. So I'm going to mark out midnight. I just have it as 0000, and then 8:30, mark out 8:30 as well. When I'm anticipating for higher prices, you can anticipate manipulation beneath these levels, and that's where you can also hunt for changes in the state delivery to occur beneath midnight or 8:30. If 8:30 is above midnight and price is in a buy program, all you need is manipulation beneath 8:30. You wouldn't need it to go below both. Like if price was right here, let's say price is in this black shaded area, all I need for it to go is beneath one of them. So we have 8:30. Beneath that is fine. If it goes beneath both and I'm anticipating for higher prices, price is at a deep discount. So over here, you have price manipulating beneath midnight, and then it starts to expand up. If price is in a buy program, the low of the day will form beneath midnight or beneath 8:30 open. If midnight is above 8:30, then all you need is for price. You just need price to go below the highest one. Okay. So it opens up at 8:30, trades beneath here. This is manipulation. Price starts to expand up, creates a change in state delivery. Notice how that puts in the low of the day. And then price starts to expand higher. I typically would recommend using like a 5 minute and above for trying to frame the low of the day. Just because if you're looking at a 1 minute in here, you'll see so many little tiny changes in the state delivery. Remember, we're looking for those changes in the state delivery at key areas. So we have the sell side liquidity here. Price manipulates beneath there. You get a 15-minute change in the state delivery. That puts in low of the day. If we look over here, same idea. Notice how midnight is all the way up here, and then 8:30 opens, and it's beneath both of those at 8:30. That means that this is a deep discount, and since we're anticipating for higher prices here and the draw on liquidity is higher, when price runs the sell side liquidity, this is where we can hunt a change in the state delivery. If you look at my executions on Tuesday, you'll notice this is where I go long. Price creates a change in the state delivery on the 15-minute time frame. Beneath 8:30, it's likely to put in low of the day, since I'm anticipating for price to draw up into here. Okay. Price starts to expand higher, expands higher the rest of the day. The bias is still for price to trade up in here. And why am I expecting that? Remember, the 9-hour time frame. Again, it doesn't matter what time frame you use here. I'm just trying to show this huge imbalance. And once price starts to expand back towards that, this is a high probability draw because price is going to want to, when you have such a big imbalance right here, it creates a liquidity void. And these liquidity voids like to get rebalanced. So this blue area, the high of that fair value gap is a likely draw. So until we reach into that, that's going to be my bias. Notice how we reach into that, and then I said I have no higher time frame bias now. I think I might have said ES. I was explaining this. I meant to say NQ. Not sure if I did. But we have that bullish bias until it draws up into there. Okay, we have midnight here. Price expands lower. 8:30. Opens up, expands lower. Look for a run on sell side liquidity beneath these levels. And then you can anticipate for price to break higher. Once it does that, creates a change in state delivery on the 15-minute time frame. This is when you already have the bias. So I'm telling you guys, once you already have that bias where price is heading and it creates a change in state delivery, again, use above like a 5-minute time frame just for more precision elements, that will put in low of the day most of the time. So, okay, Dan, well, what about right here? Price manipulated beneath 8:30 open, created the change in state delivery. Did it run liquidity? No. So left these relative equal lows. This is just a little Judas swing higher, manipulates back down. When we get something like this, this is when I can already anticipate a breaker will form. So I'll dive into this for a second, and then we will move on to the psychological aspect of this video. Once I see something like this where price returns back to the sell stops, it leaves these relative equal lows and we start to expand higher. When 9:30 opens, I'm anticipating this entire move up to just be inducement, and I'm anticipating for a breaker to form. So what happens in a breaker is you get a low, a high, and then you get the manipulation swing down. So once we get that manipulation back down, I'm anticipating for this to put in the low of the breaker and then anticipate for price to expand back higher. So remember, we're anticipating for price to draw up into this level. I'm looking for low of the day to form beneath midnight and 8:30 open. This initial move up, since it doesn't take out sell stops, I'm anticipating for this to be the inducement leg of the breaker where it induces retail long. This is the manipulation leg of the breaker because it's taking out the retail buyers. And those buyers, when their stop loss gets triggered, it turns into sell stops. So smart money's buying from the sellers at a discount. When this occurs, since I'm already anticipating for price to head higher, I can go down into a 1-minute time frame in here. And once it forms the change in state delivery model, since it took out the sell side liquidity, this is where I can anticipate low of the day to form down here. Because what am I doing? Well, I'm anticipating for price to start drawing into the buy side now. And the reason I'm anticipating that is because sell side was swept. We had a bullish change in the state delivery, and now we have buy stops above. Now think about this for a second. We have a lower time frame change in the state delivery. I'm anticipating for price to draw up into the buy side. And where is the inception of this retracement back down? The inception of that is right here. So I'm anticipating for a market maker buy model to be in play where it takes out all of these old highs. So I'm anticipating for that. And price takes that out. But what happens when this lower time frame change in the steady delivery takes out this high up here? Well, now it turns into a higher time frame breaker. So if we go to a 5-minute time frame, notice how that lower time frame change in the steady delivery made price take out the original consolidation of the market maker buy model. This was the smart money reversal, price targeted higher. Once it takes out this, well, now it's taking out this high up here. So now we have a higher time frame breaker. So that's how I can anticipate the low of a breaker. That's how I can trade the breaker before it even becomes the breaker. And again, the breaker will form across the multiple up close candles that form in that high, but the last up close candle will be the sweet spot of that breaker. It's going to be the most sensitive point. So now I anticipate for this to be the low of the day down here. If we let this play out, it returns back into the last up close candle, and then price just starts to expand the rest of the day higher. So that's how I can utilize 8:30 and midnight open. When I already have a predefined level where I think price is going to draw towards, I can wait for price to run liquidity beneath 8:30 or midnight. Again, it just needs to be beneath either of them. Same applied if you are bearish, just wait for manipulation above either of them. If it's above both of them and you're bearish, that's an extreme premium to short at. If you're bullish and you're anticipating price to draw higher and it's beneath both 8:30 and midnight and you run sell side liquidity down there, that's an extreme discount to buy at. Again, we're not randomly buying down there. We're waiting for a run on sell stops and also a lower time frame change in the steady delivery. If you want to learn this from the source, check out the 2022 mentorship. ICT talks about it in that mentorship. It's about 41 videos. I know it is a lot to sit through, but he really teaches you patience because it's like hour-long videos. So now I want to dive into the psychology part of this video. I have a few points that I want to cover. I'm going to talk a little bit about my tendencies as a trader, and if I could go back 3-4 years ago when I started trading and tell myself what I know now, what I would tell my beginner trader self. The first thing I want to cover is identifying your tendencies. So what is the biggest barrier that you face in your trading? Is it revenge trading? Is it FOMO? Is it nervous to get into a trade? Do you get super emotional after a trade? And just kind of different exercises that I've came up with to help prevent some of these things, because you need to have an exercise. Once you get that initial thought, how are you going to redirect that thought in a positive way versus just acting like it's not there? You need to identify your emotions as soon as you get them. So revenge trading, what's a good exercise to prevent revenge trading? As soon as you take a losing trade, that initial thought of I need to get this back, but it's subconsciously, so you're not thinking out, you're not saying out loud, all right, I need to get this money back. You're just kind of, it's just an emotion running through yourself. A big thing that has helped me is waiting 10 to 20 minutes after a loss. If you wait 10 to 20 minutes, go for a walk, go downstairs, grab something to eat, just do something. Just get off the charts for 10 to 20 minutes. Just allow myself to recalibrate, reset, realize that one loss absolutely means nothing, and to focus on 10 plus trades. That's kind of my motto that I kind of stand by, that I judge my performance over a series of trades. Having that mindset and repeating that in my brain with positive self-talk, just saying, all right, one trade doesn't matter, 2 trades, 3 trades don't matter, because my performance over a series of trades does not matter. And if you have a 1 to 2 risk to reward, if you have a 40% win rate, you're break even. So constantly with that repetition, telling yourself, all right, this trade doesn't matter. So I'm walking away for 10, 20 minutes. I judge my performance over a series of trades. One trade means nothing. Even if I go back in 20 minutes and lose the next trade, this isn't going to affect me a week from now, because I know as long as I have above a 40% win rate, I can make money. So that'd be the first thing, revenge trading. Set a timer for 10, 20 minutes. If you want to make it 30, if you want to make it an hour, it really depends on your strategy and what works best for you. If you notice, if it's just 10 minutes and you're creeping up on 7, 8 minutes and you're like just staring at the timer, waiting for it to go off so you can get back in a trade, that's not the idea here. The idea is to, after 10 minutes, come back with a clear mind, have absolutely no bias on the chart. Don't care what the bias is, what your preconceived thought of where price was going to go. Just totally eliminate that. The goal is to just wipe your mind clean. So setting a timer definitely helps with that. So the next thing I have written down is FOMO, fear of missing out. And it's important to confront these thoughts. For a while, I just acted like they weren't there. I just tried to ignore them. And that's the worst possible thing you could do. You want to realize what you're thinking, become conscious of those thoughts. And really, for a while, what I did is just write out my thoughts on paper. If I'm feeling emotional, I write down, okay, today it's 10:06 a.m. I'm feeling emotional. I took one loss. I feel like I want to get into another. You just start writing all these things out, and then you just sit there and read it. And you just start to say to yourself, why am I thinking this way? Well, I'm thinking this way because I'm giving too much emphasis to one trade. And then I go back. Well, in my strategy, my goal is to focus on 10 trades. If I look at my previous performance, I lost 2 trades in a row, but then I won 4 or 5 in a row. So really, in a larger perspective, this doesn't mean anything. So confronting your thoughts and then reinforcing positive self-talk, I think that's super important. Another thing to gain confidence and not let that FOMO overtake you is backtesting. Backtesting so much that you get so bored of it. I have hundreds, if not thousands of hours backtesting over a series of years, obviously. Because I'm going on, I believe February, March will be 4 years in crypto related stuff. And I believe October, November was just over 3 years in trading. So I've been in this game for a while to know the negative thoughts that you get while you're thinking, how to redirect those thoughts into positive self-talk. Backtesting and gaining confidence in your model will help reduce FOMO. For me, I need to know why price is doing what it's doing. I need to have an answer for every single price move. That's just how my brain works. I need to understand why it did this, why it did that. And the only way to understand that is to backtest. I needed a model that was going to be here all the time. Because if I'm trading a model and it's only here once a week, and I lose that trade 2 weeks in a row, in my mind, I don't work that way. I need something that's going to be with my personality trait. I'm just being honest. I can't wait 2 weeks for a setup. So I needed to find a model that was going to fit my personality, and I found a model. I spent tons of time studying this model right here. It's going to be here every single day. So knowing my model is there every single day, now I can go a week. If I want to take a vacation, I could take a week off. I don't need to be trading because I know that when I come back the next week, it's going to be there. And it's going to be there every session. Doesn't mean you're going to be right every session. Doesn't mean you're going to capitalize on it every session. But knowing it's there, and it almost provides like a sense of security that, okay, this model is going to be here. Now I can focus on the on the most A+ setups because I don't have to worry about it not being there. I don't have to worry about missing this opportunity. For me, having a strategy that was only there 1, 2, 3 times per week, I'm on my charts just absolutely staring at the computer for 8 hours straight, making sure I don't miss the setup, and it's mentally draining, I could tell you that. Next thing I want to talk about is nervous to get into a trade. If you're nervous to get into a trade, you're doubting your model and you haven't done enough studying. So I would recommend doing tons of backtesting, study more, journal more, and once you start to get your confidence up, going with the lowest leverage 1 micro contract on the S&P 500 or the NASDAQ in futures, extremely low leverage. 1 point, I believe, is $5 for every micro, and for NQ for a micro, it's going to be $2. So a 10-point move is $20 using a micro. A 10-point move is going to be $50 using a micro on the S&P. So using the lowest leverage, if you are nervous to get into a trade, backtesting, journaling, studying your journal, forward testing, just tape reading, and paper trading, and then moving on to the lowest leverage possible. That's not financial advice, by the way. By the way, it is very windy outside, so if you hear my mic picking up something weird, it's the wind outside. Now, if I could go back and tell myself 3 to 4 years ago when I first got into these markets what I know now, here's what I would tell myself. I would say, Dan, stick to one approach. Don't go all over the place. What I was doing for the longest time is trying out all these different strategies. I would build up equity, and then all of a sudden I'd go on a losing streak. And I'm not talking about 1, 2 trades. I'm talking about 5, 6, 7, 8 trades losing in a row. And all of a sudden it's the end of the world, and I'd have to switch something. I'd have to change strategies. And then changing strategies, you start to see improvement, but then you're new to that strategy, and then it's refining that strategy, and it's an endless loop of building upon new strategies, refining that strategy to understand it, going on a losing streak, changing the strategy, and doing that for the longest time. And if I could tell myself back then what I know now, I would say stick to one approach, Losing streaks are normal. You're going to lose 6 trades in a row sometimes, but how do you perform over 40, 50, 60 trades? That's what really matters. If you keep on testing out new approaches, you have no edge. What I would also tell myself is address the negative thoughts that you have in your mind. When you have these negative thoughts of, I need to make it back, I'm feeling FOMO right now, I'm nervous to get into a trade, I would tell myself, come up with these exercises to address those thoughts. Don't just act like they're not there. Because when you act like they're not there, they're manifesting in your trading. If you have these subconscious thoughts of being nervous, you just feel that emotion, you feel that anxiety getting into a trade, that's 100% going to manifest into your trading. So losing is normal. It's another thing I would tell myself. It's completely normal to go on losing streaks. It's completely normal to go on winning streaks. Staying level-headed throughout all of that is the most important part. So the last thing I would tell myself is that trading is waiting. You're going to be doing a whole lot more waiting than trading, so get used to it. This game can be extremely boring at times, but your trading should be boring. How you stay level-headed throughout that boredom is paramount in your future success in trading. That's going to wrap up this series. If you guys made it to the end, congratulations and thank you for sticking along. This was super fun to make. If you guys feel led to, please leave a testimonial in the testimonials tab. I will probably post some of them. Again, no pressure, just if you feel led to do that, then that is there. But I'll catch you guys next week and have a great weekend.